Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. This video is going to be focused on the SP 500 that's been coming down violently here after this rejection off this downtrend line. Lots of volatility. We're seeing the market cover years worth of gains, years worth of losses in just a few days here. This just shows you the huge amount of volatility that we're seeing in the market right now. Now, of course, this comes after a 13-year bull run on the S&P 500 that led long-term valuations on the S&P to levels that are comparable to what we saw during the dot-com bubble, with the very top of the dot-com bubble, and also in 1929, right here, just before the Great Depression. Obviously, both instances in 1929 and 2000 led to a lot of pain ahead for investors who were not risk averse. Now, this also comes as the Federal Reserve, which is often awarded the prize for propping up the market for the last 13 years. The same organization now seems to be determined to bring the market down. Neil Kashkari, one of the members on the Federal Reserve's board, said recently that he was happy to see the stock market's reaction after Jackson Hole, which was indeed a pretty severe market reaction here, with the stock market moving down a quick 5.5% from the moment that the meeting started. So will the Fed's war on the stock market be enough to end this secular bull run that we've had on the S&P 500 since 2009 that has really been comparable to the secular bull run that we saw between 1982 and 2000 in terms of the length and sheer magnitude of the moves? That's the question that we're trying to answer in these videos. We look at what's going on in the markets multiple times a week and try and figure out where the opportunities are. If you're interested in following these crazy markets with us, don't forget to smash that subscribe button. Also, click on that like button if you enjoy this episode. It is really appreciated. It really does make all the time that we put into making these videos. It makes it worthwhile, and hopefully you guys benefit from it. Now, without further ado, let's get right into this. Now, in this episode, we're going to take a look at whether some of the positive signals that we saw throughout this rally, we had a few breadth thrust signals, very strong market reaction throughout this period, whether that has been invalidated by this recent move. That's a very important question to ask, and I think everybody needs to be open-minded regarding that. Now, of course, the strength that I'm referring to is in great part this signal that we got a couple of weeks ago that was the S&P 500 breadth, the percentage of stocks above their 50-day moving average. The market went from an extremely oversold reading to an extremely overbought reading, and that has only really happened a handful of times in recent market history, including the dot-com bear market and the 2007 to 2009 stock market crash. This is a signal that has only appeared before big runs, and it hasn't appeared during the big bear markets. We see no such strength during the big bear markets in 2000 and 2007. And so just based on this data set, it did increase the odds significantly that the June low that we saw a couple of months ago was a significant bottom that was unlikely to be revisited. We don't have a crystal ball. We're not looking to have a crystal ball, but the market behavior during the rally did show an incredible amount of strength that is not consistent with seeing a revisit of the low. And you can see in all of these cases, the low is not revisited. But obviously, we've seen quite an impressive move down. So we have to ask the question, at what point is this signal invalidated, which would increase the odds of seeing a retest of the low? Has that already happened? And the way I've taken a look at this is to really see the drawdown that you get following these signals. So I put a vertical line every time that we got that breadth thrust signal, that same strength that we saw back during the July and August rally. These are the maximum drawdowns that you get after that kind of strength. 5% drawdown in 2009, 1.5 in 2000. And so you can see here the drawdowns range from 1.5%, so almost no drawdown in 2010, to 10% in October of 2011. So if we put these readings on this chart, these drawdowns on this chart, you can see that most drawdowns occurred in this range here. So you can see that the move we've had so far here ever since that peak, after this big rally showing a lot of strength, it is bigger than what you would expect after that kind of move up. Now, if you remember on the site and you've been following our regular updates on the market over the past couple of weeks, you'll know that 4,100 point was a big level of support. And we can take a look at that on this chart right here. Not only was there this bullish trend line, this price channel here, but it's a pretty big level of support at around 4,096 points. And so failure to hold that level would increase the odds of a deeper pullback to 3,900 points. And so essentially breaking that cluster of average drawdowns that you get following a breadth thrust. And so one way you can also look at this is that breaking 4,100 points, which was fueled by the Federal Reserve's speech last Friday, that took the market down lower than the average drawdown you'd expect after such a rally. Now you can see the 2011 drawdown, which was 9.8%. If that were to occur again today, would take the market around to 3,900 points, which if we take a look at the technical structure here, we know there's a lot of support at around 3,900 points, both in terms of the price, lots of support around these levels, lots of people waiting to buy at around 3,900 points, and also in terms of the trend line support right here that connects these two lows, as well as the 61.8 retracement level that's right here, just below 3,900 points, right? So you've got this huge confluence of support at around 3,900 points, which is why we think it's going to be a magnet over the coming days. But if it starts to break this structure, that's bad news, right? And it's bad news from quite a few different standpoints. First of all, you're breaking below 61.8 retracement, which is the maximum retracement you can get during an uptrend, right? If it breaks that, the uptrend is technically over and you are back in a downtrend. And you've confirmed that this was indeed just a counter trend rally and not the beginning of a new trend. And you also break the last potential historical comparison to 2011, where we did see that type of drawdown following a successful breadth thrust signal. When you take 2,900 points out, it would officially invalidate this signal because you've never had a drawdown larger than this following a breadth thrust signal. Now, does that mean that the bullish case for stocks suddenly evaporates if we break 3,900 points? In our opinion, absolutely not. We have good reason to believe that at least in the next few months, you're going to see inflation rolling over, and we are already seeing early signs that we're going to see a significant move down in inflation in the months ahead. Just the manufacturing prices paid here has been collapsing, and that usually leads CPI data by around a couple months. So we should theoretically see a lot of weakness here just in the next couple of months, which could relieve some pressure off the stock market. And we also expect earnings to hold up a lot better than what most people are expecting, at least over the next couple of quarters. Just over the next 6 months, expectations on earnings are already very low, and we don't think that we should be that pessimistic yet on stock market earnings. Diving deeper into that in the next couple of weeks, we're going to be posting 2 very important articles, what I believe are going to be 2 very important articles looking at the earnings picture on the SP 500 and also the inflation story and how that's developing right now, along with some revised target for the SP 500 and our favorite sectors and industries right now. If you're looking to stay up to date every step of the way, whether that's on the macroeconomics, the fundamental driving factors behind the market right now, or whether that's diving into the technicals and the underlying macro market dynamics and staying up to date with our trading watch lists and seeing how all of our trades are organized and the recent updates that we've made on the assets and sectors we look at using the trading watch list. If you would be interested in testing out that type of service, we do provide a free trial, a 7-day free trial where you can test out the service completely for free. Look at the kind of work we're doing, the kind of calls that we're making and the reasoning behind those calls. And if you're convinced, you can join the community. To recap, we remain pretty optimistic on the macro environment. We're perhaps a lot more contrarian than what most people online are talking about right now. But the problem with macro is that it can take a long time to play out, right? It's not going to happen overnight. Macro takes time to shift, it takes time to really appear. And while sometimes it can be quick, right? It can be a V-shape recovery or a pandemic-induced flash crash. Most of the time, things take time to really play out. And that's where we use the technicals, the market dynamics to actually figure out perhaps what the odds are that a bottom is in and that you're going to see short-term upside or short-term downside. And the reality is that if 3,900 points does not hold, it does break a lot of the bullish technical structure that we have in the market right now and opens the door for a retest of the low and will likely delay the potential for the 4,600 point level to be hit in short order. So this is something we're going to be looking at very carefully over the next couple of weeks. We have the CPI reading that's coming out on the 13th of September. We have reason to believe that it's going to end up being weak. It's going to end up surprising to the downside, which could potentially make the market hold this bullish structure and to revive the rally. But of course, that is short-term speculation. We'll be watching this very objectively and seeing what the market is telling us. Now, if you enjoyed this episode, don't forget to smash that like button. It is really appreciated. If you're new here and you enjoyed this episode and you want to stay up to date on the markets, make sure to smash that subscribe button. Now, in the meantime, I wish you good luck on your trading and see you next time.